Let's now learn about the definitions prescribed in Chapter 5 of the 2019 FSI's Guide for the elements of the sectoral balance sheets, or in IFRS terms, the Statement of Financial Position. We will use the deposit taker sector as our example. Many of the definitions used are also applicable to the other financial corporations, or OFC, subsectors. Total assets, line 14 in the table, is the sum of non-financial assets, line 15, and financial assets, line 16. Non-financial assets provide benefits to their owners, but do not represent claims on other institutional units. Examples are property and equipment owned by the institutional unit. The balance sheets of deposit takers and OFCs generally will have a small proportion of non-financial assets. Remember that financial assets are claims arising from contractual relationships whereby one institutional unit provides funds or resources to another. Each financial asset has a corresponding liability. Each financial instrument may be an asset or a liability. An asset on the balance sheet of the institutional unit providing the funds or resources, a liability on the balance sheet of the institutional unit receiving the funds or resources. Currency, lines 17 and 24, comprises notes and coins of fixed nominal value. Deposits, lines 17 and 24, are standard, non-negotiable contracts open to the public at large that represent the placement of funds available for later withdrawal. As an asset of a deposit taker, deposits may include claims on the central bank and some OFCs. Deposits placed by one deposit taker with another deposit taker are not classified as deposits on the asset side of the balance sheet and instead are recorded as interbank loans. Deposit liabilities, line 24, are usually the largest funding source for deposit takers. Customer deposits, which are generally considered to be more stable than other types of funding, are reported separately from interbank deposits and other currency and deposits. Customer deposits includes all deposits placed by residents or non-residents, except those placed by financial corporations, central governments, and central banks. Loans, lines 18 and 25, are financial assets that are created when a creditor lends funds directly to a debtor and are evidenced by documents that are not negotiable. Not negotiable means that legal ownership cannot readily be transferred from one unit to another unit by delivery or endorsement. Loans differ in this way from debt securities, which are designed to be negotiable. Loans are typically the largest single asset class for deposit takers. This asset class includes many different types of loan, including overdrafts, commercial loans, installment loans, finance leases, and repurchase agreements. While not reported separately on the sectoral balance sheet, loans collateralized by mortgages on residential or commercial real estate should be separately identified in the memorandum series for FSI calculation. The 2019 FSI's Guide recommends recording gross loans, less specific provisions, as a negative or contra asset item, line 18.II, on the balance sheet. Loans may also be a liability for a deposit taker, providing a funding source, line 25. Debt securities, line 19 and 26, are negotiable financial instruments serving as evidence that units have obligations to settle by means of providing cash, a financial instrument, or some other type of economic value. Debt securities give the holder an unconditional right to receive interest and/or principal payments. Examples of debt securities include bills, bonds, debentures, commercial paper, negotiable certificates of deposit, and asset-backed securities. Debt securities may be held as assets, line 19, or may be issued as liabilities, providing a funding source, line 26, for the deposit taker. Line 20 includes equity instruments and investment fund shares. Equity comprises all instruments and records acknowledging claims on the residual value of a corporation after the claims of all creditors have been met. Investment fund shares are shares or units of all kinds issued by money market funds and non-money market funds. Recall that non-money market funds are collective investment schemes such as mutual funds which raise funds from the public. Financial derivatives, line 21 and 29, comprise instruments that are linked to another specific financial instrument, indicator, or commodity. Financial derivatives permit specific financial risks, for example, foreign exchange risk, to be traded in their own right. The value of a derivative depends on the price of the underlying item or reference price. The 2019 FSI's guide clarifies that employee stock options are a form of derivative liability and when issued should be included in line 29 with other derivative liabilities. All financial assets and liabilities not elsewhere specified should be included in line 22, financial assets, and line 27, liabilities. Recall that the 2019 FSI's guide defers to national supervisory standards for the allocation of International Financial Reporting Standard, or IFRS 9, allowance for expected credit loss, or ECL, to general and specific provisions. General and other provisions, line 30, should be presented as liability items even though they are internal accounts to reflect potential future losses rather than obligations to creditors. Specific provisions reduce the net value of the asset on the balance sheet. Capital and reserves, line 31, is the equity interest of the owners in the enterprise. Capital and reserves comprise the difference between the value of total assets, line 14, and the value of total liabilities, line 23. It represents amounts available to absorb unexpected losses.